October 1907. New York City. The air isn't just cold, it is thick with terror. Imagine standing on the corner of 34th Street and 5th Avenue. You see men in expensive suits, men who run empires, weeping openly on the sidewalk. You see lines of people stretching for blocks, desperate, clawing at the bronze doors of the Knickerbocker Trust company. They aren't trying to get a loan. They aren't trying to make an investment. They are trying to get their own money out before the doors locked forever. It was a bloodbath. In a matter of days, the New York Stock Exchange fell nearly 50%. Banks that had stood for generations evaporated into mist. The suicide rate in the financial district spiked. The American dream was being strangled in real time. History books, the ones used in the public schools funded by the very system we live under today, they tell you a specific story about this moment. They tell you it was a natural disaster, a random storm of bad luck and market mechanics. And they tell you that one man, a hero, stepped in to save the Republic. J.P. Morgan. They say he locked the bankers in his library and forced them to bail out the system, saving America from total collapse. It is a beautiful story. It is heroic. And it is a lie. What if I told you the arsonist was the one leading the fire brigade? What if I told you that the panic of 1907 wasn't a random disaster, but a controlled demolition? A crisis manufactured with cold mathematical precision to force a desperate American public to accept the one thing they had hated since the founding of the country, a central bank. You are watching your purchasing power vanish today. You are watching banks wobble and collapse in 2024. You are told it's transitory or unexpected. But if you want to know what happens next, you have to look at the blueprint. The blueprint was drawn in 1907. The crisis created the monster, and the monster is currently eating your savings. I want you to pause for a second. Go to the comments right now. Tell me where you are watching from, and tell me, do you trust the Federal Reserve to protect your money? Put a simple yes or no, because by the end of this video, that answer is going to change.
To understand the theft, we have to understand the scene of the crime. Let's go back to the Gilded Age. America in the early 1900s was a feral, powerful beast. There was no Federal Reserve. There was no income tax. The currency was backed by gold. If you had a dollar, it was a claim on physical metal. It meant something. But for the banking elite, this was a problem. A gold standard is a leash. It prevents governments from spending money they don't have, and it prevents bankers from lending money that doesn't exist. It keeps the game honest. And the biggest players on Wall Street, J.P. Morgan, the Rockefellers, the Warburgs, they were tired of being honest. They wanted a system where they could print liquidity on demand. But they had a massive obstacle: the American people. You have to understand the mindset of the average American in 1900. They despised centralized power. They hated the idea of a central bank. They remembered the warnings of Thomas Jefferson and Andrew Jackson. They knew that a central bank meant the government and the elites would be in bed together, picking your pockets through inflation. So the bankers had a dilemma. How do you get a free people to sign their own enslavement papers? How do you get a population that hates central banking to beg for one? There is a formula for this. It is as old as politics itself. Problem, reaction, solution. You create a problem, a terrifying financial collapse. You wait for the reaction. The public screams, "Do something! Save us!" You offer the solution, the very central bank you wanted all along. Sound familiar? Think about 2008, the housing crisis, the bailout. Think about 2020, the lockdowns, the stimulus checks. Think about 2023, Silicon Valley Bank, the emergency lending facilities. Every time there is a crisis, the solution is always the same. More power for the central planners, more consolidation for the big banks. But 1907 was the masterclass. It was the big bang of financial manipulation. The economy in 1907 was actually booming, but it was fragile. There was a new player in town called trust companies. Think of these like the crypto exchanges or the shadow banks of today. They acted like banks, they took deposits, but they were regulated lightly. They took massive risks. They were over-leveraged. Sound familiar? It creates a high-yield, high-risk environment. And sitting at the top of the food chain was J.P. Morgan. He wasn't just a banker, he was the Jupiter of Wall Street. He controlled railroads, steel, electricity. If money moved in America, it moved through his fingers. Morgan saw the trust companies as a threat. They were competitors. They were stealing market share from his commercial banks. He wanted them gone. And he wanted a central bank to ensure his empire could never fail. So the stage was set. The gunpowder was piled high in the streets of New York. All it needed was a spark. And history tells us that spark came from a failed attempt to corner the copper market. But here is where the official narrative starts to crack. The spark was the Knickerbocker Trust Company. It was the third largest trust in New York, a behemoth. It had dealings with some speculators who lost money on copper. When the rumors started that Knickerbocker was insolvent, the president of the trust, Charles Barney, went to see J.P. Morgan. He went to the hero. He asked for help. He asked for a lifeline to calm the markets. Morgan looked at the books. He had the money. He had the power to stop the panic before it even started. He could have made a statement. He could have injected liquidity right then and there. He didn't. J.P. Morgan refused. He let the news leak that he would not support the Knickerbocker. Why? Why would the savior of Wall Street let the third largest trust collapse? Because he needed the fire to get hot. He needed the panic to spread. When Morgan said no, the run on the bank began. People lined up. The Knickerbocker collapsed. Charles Barney, the man who begged Morgan for help, would later commit suicide.
But the fire didn't stop there. It jumped to the street. People saw one bank fail, so they ran to the next. The Trust Company of America came under attack. Now here is the twist. This is the part that makes the hair on the back of your neck stand up. When the Trust Company of America started to fail, Morgan suddenly decided to get involved. But he didn't save them immediately. He gathered the other bankers. He delayed. He waited. He waited until the terror was absolute. He waited until the headlines were screaming about the end of the American economy.
He waited until the stock exchange literally threatened to close early because there was zero money to buy stocks. On the floor of the exchange, the interest rate for overnight loans, what we call the repo rate today, hit 100%. 100% interest, just to borrow money for 24 hours. The gears of capitalism had ground to a halt. It was only then, when the entire country was on its knees, that Morgan opened his wallet. But the receipt is wilder than you think. Morgan didn't just bail out the banks out of the goodness of his heart. He used the crisis to consolidate his power. He let the weaker competitors die. He bought up assets like the Tennessee Coal, Iron, and Railroad Company for pennies on the dollar. He required special permission from President Theodore Roosevelt to violate antitrust laws to do it. And because the president was terrified of the crash, he said yes. Morgan effectively blackmailed the U.S. government. Let me break the law. Let me buy my competitors, or the economy dies. It was a masterstroke. But the real objective wasn't just profit. It was policy. As the dust settled, the narrative was already being written by Morgan's associates. The newspapers, many of which were influenced by Morgan's circle, screamed the same headline: "This must never happen again." They said, "We cannot rely on one man to save us. J.P. Morgan won't live forever. We need a system. We need a lender of last resort. We need a central bank." This is the core deep dive. We need to look at the mechanics of how they turned this panic into the Federal Reserve. Immediately after the 1907 panic, Congress passed the Aldrich-Vreeland Act. This established the National Monetary Commission. Its job? To study the banking system and recommend changes. Who led it? Senator Nelson Aldrich. Now, who was Nelson Aldrich? He wasn't just a senator. His daughter married J.P. Morgan's son. He was deeply embedded in the banking cartel. Aldrich spent 2 years touring Europe, dining with the Rothschilds, studying how the central banks of Europe controlled their populations. He came back with a plan. But they knew they couldn't just introduce the Aldrich Bill. The public hated Aldrich. He knew he was a banker's stooge. If they proposed a central bank, it would be dead on arrival. So they needed to write the legislation in total secrecy. They needed to disguise it. In November 1910, a secret train left Hoboken, New Jersey. The blinds were pulled down. The passengers were told to use only first names. On that train were Nelson Aldrich, A.P. Andrew, Assistant Secretary of the Treasury, Frank Vanderlip, President of National City Bank, representing the Rockefellers, Henry Davison, Senior Partner at J.P. Morgan Company, Benjamin Strong, another Morgan lieutenant, and Paul Warburg, a partner at Kuhn Loeb and Company, representing the Rothschilds. This wasn't a government meeting. This was a cartel meeting. The Morgan faction, the Rockefeller faction, and the European banking faction. They traveled to Jekyll Island, off the coast of Georgia, a private club owned by J.P. Morgan and his associates. For 9 days, they sat in a hunting lodge and wrote the legislation that would become the Federal Reserve Act.
Paul Warburg, the architectural genius behind the plan, insisted on 2 things. First, do not call it a central bank, call it a Federal Reserve. The word federal implies it's government. It isn't. The word reserve implies it has money. It doesn't. It prints it. Second, make it look like it is decentralized. Create 12 regional banks so the farmers in the South and West think New York isn't running the show. But in reality, rig the rules so the New York branch runs everything. They wrote the bill to look like it was restricting the banks, when in reality, it was giving the banks the ultimate power. the legal monopoly on the creation of money. They brought this bill back to Washington, but they played a game of 4D chess. When the bill was introduced, the big bankers, Morgan and Vanderlip, publicly criticized it. They pretended to hate it. They gave interviews saying the bill would be bad for banking. Why? Because they knew the American public didn't trust them. If Morgan hated the bill, the people would think, well, it must be good for us. It was reverse psychology on a national scale. In 1913, under President Woodrow Wilson, the Federal Reserve Act was passed. It was voted on just days before Christmas, when many opponents in Congress had already gone home for the holidays. The trap was sprung. Let's look at the numbers. Let's look at the scorecard of this solution that was born from the panic of 1907. The Federal Reserve was created with three main mandates: stable prices, maximum employment, and moderate long-term interest rates. How have they done? Statistic number 1. Since the creation of the Federal Reserve in 1913, the U.S. dollar has lost approximately 98% of its purchasing power. A dollar in 1913 bought you a day's worth of labor or a pair of quality shoes. Today, it buys you 3 minutes of parking. That is not stable prices. That is theft. Statistic number 2. Financial panics did not stop. In fact, they got worse. The Great Depression of 1929 happened just 16 years after the Fed was created. The Fed didn't prevent it. They caused it by contracting the money supply when they should have expanded it. Statistic number 3. The consolidation of banking. In 1907, there were thousands of small, independent banks. Today, the top 5 banks in the U.S. control nearly 50% of the entire industry's assets. The system designed to prevent panic actually designed a system where the indistinct, too-big-to-fail banks consume the small ones every time there is a crisis. Statistic number 4. Public debt. In 1910, before the Fed, the U.S. national debt was $2.6 billion. Today, it is over $34 trillion. The Fed enables the government to borrow infinitely, passing the bill to you through inflation. Statistic number 5. Wealth inequality. The mechanism of the Fed pumping money into the financial system benefits those who own assets like stocks and real estate and hurts those who work for wages. Since the Fed went into overdrive in 2008 and 2020, the wealth gap has widened to levels not seen since, you guessed it, the Gilded Age of 1907.
The Panic of 1907 was a psychological operation. J.P. Morgan and his associates utilized the chaos of an unregulated shadow banking market to terrify the public. They withheld liquidity to let the pain maximize, and then they offered a solution that gave them permanent control over the currency supply. They moved us from a system of hard money and risk to a system of soft money and moral hazard. In 1907, if a bank made bad bets, it died. The depositor lost money, yes, and that was painful, but the bad behavior was punished. Today, if a bank makes bad bets, the Federal Reserve prints $1 trillion, devalues your savings, and hands the fresh cash to the banker to pay his bonus. The Panic of 1907 taught the elite a valuable lesson. Fear is the currency of change. If you want to radically alter society, if you want to take away sovereignty, you don't ask for permission. You wait for a crisis. Or, if you're impatient, you manufacture one. This brings us to today. Why does a panic from 117 years ago matter to you right now? Because we are in the problem phase again. Look at the headlines. Regional banks are failing. The repo market, the plumbing of the financial system, is showing cracks just like it did in 1907. The debt is unsustainable. The interest rates have spiked faster than at any time in history. They are letting the system wobble. They are letting inflation run hot. They are letting you feel the pain at the gas pump and the grocery store. Why? Because they have a new solution they want to sell you. In 1913, the solution was the Federal Reserve note, the paper dollar, and the central bank. In 2025 or 2026, the solution will be the CBDC, central bank digital currency. They will tell you the current system is too slow, too archaic, too prone to bank runs like Silicon Valley Bank. They will tell you that to save the economy, to ensure you get your stimulus checks instantly, to ensure financial stability, we need a fully digital programmable dollar issued directly from the Fed. They will use the next panic, the next 1907, to force you into that system. If you don't understand the history of 1907, you will view the coming crash as an accident. You will view the government's response as incompetent but well-meaning. But if you understand 1907, you will see it for what it is. It is a consolidation of power. It is the final closing of the gate. J.P. Morgan didn't save the country. He bought it. And the receipt is in your wallet, losing 8% of its value every single year. The monster wasn't found under the bed. It was built on Jekyll Island, and it is currently hungry. Don't let them sell you the same lie twice. If you want the unfiltered truth about money, history, and how to survive the next manufactured crisis, you know what to do. Subscribe.